talk about whether there's overall that kind of enthusiasm in the markets or not. We've got Maneesh Dangi joining in on the show right now. Maneesh, hi. Good to have you in the show as always. While we're counting down to an all-time high on the market, already there at 20K and 21K as well, perhaps soon. Just wanted to understand how is it that you're looking at both the India as well as the global construct?
So India markets are chugging along really well, macro decent. There's a bit of a slowdown underway in US. Most other countries are already, say Europe and others are in recession. So I think the big news over the last 2-3 months is a positive one that there's a significant amount of disinflation there in developed markets, which basically takes this risk away that you could be further higher from here in terms of interest rates. And that's perhaps the reason why you've had a good kind of a pre-Santa or Santa rally in developed markets.
Yes, indeed. Santa rally is perhaps the only way we can describe it. But after a slew of brokerages came ahead and upgraded India and spoke about the India story, now it seems like there is a little bit of caution on the street. With respect to the elections in mind, what do you believe the next big concern or risk for India is going to, where do you believe it's going to emerge from?
So India risk are not micro corporates sort of seem decent. Margins are rolling over, but it's very likely that over the next couple of years, India Inc. would do well. Economy would slow, but won't slow substantially. So it's not the interiors of the market which is going to pose risk to Indian markets. It's a too big risk which is likely to take some steam off over the next 12 months. If at all, from market. One, as you said, is election. The other is, of course, US recession. So as far as elections are concerned, I guess markets are beginning to recognize this, that it is not as done a deal. There is some probability of a negative surprise, because if the current government in the current form does not continue, it is going to take a substantial amount of zing off markets. In almost 15-20% of valuation correction could happen. So it won't happen on a single day. You know, they said today evening, some poll would suggest resetting of those risk premiums in India, that current government is coming back or not, and then thereafter, polls after poll would actually let us judge if the current government is coming back or not. So I think that's a substantial risk. Another risk, of course, is US recession, which may not hurt India as significantly as US, but it will still take 10-15% off markets.
Fair enough. And what do you make of the kind of euphoria that we've seen within the broader universe, especially of late with the mid and the small cap indices? Do you think that it's a little bit of a froth building up? What's your outlook?
So that's pretty much 2017 playing out. Lots of money coming in, small and mid cap funds. I mean, not surprising, but yeah, I mean, it is relative to any time in the past. In the institutional setup, we've never seen such huge money flowing into the small and mid cap funds, and that's perhaps that's the only reason, of course, why the valuation premiums for small and mid caps have been on a secular rise for a good 12 months now. It is euphoric. These stocks tend to be more cyclical. They tend to sort of respond to business cycle slowdowns pretty severely, and to that extent, you know, there is very little headroom for them to rise further. But the flows continue to surprise us, all of us, positively, and which is why markets continue to chug along in this space.
Manish, what's the hypothesis now for fixed income versus equities, and what's going to win the race in the year to come?
So Asha, made this point a couple of times over the last 2 years that when macro is not that great, especially policy construct is not very favorable, if valuations are at margin at some premium, which is a case even today, 10-15% premium as far as India is concerned, relative to its own historic valuation, the return that you get in the aggregate markets or the broad markets, you don't get the kind of risk premium that you generally demand. So in India, typical investors, if you talk, I would say that I seek for the excess volatility that equity offers or equity gives. I should get 4, 5, 6% excess over bonds. Now, why there has been only 1-2% over bonds and sometimes negative over last 2 years is because we entered in this market with euphoric valuations with not so great macro. I think that continues to be a case that it's very likely that until even the next year we will see that this risk premium from equity in aggregate will not be more than 1 to 3%, which is going to be somewhat disappointing. Now, people sort of confuse is that no, look, markets are still at all-time high, but then you ought to ask that anyone who did SIP or actually invested 2 years ago, did he get the returns he sought from equity? And unfortunately, the answer to that is of course no, because he got um, uh, just 1-2% excess over bonds. Now that construct even sort of today remains, and which is why for an asset allocator, Aisha, the answer is always that if this risk premium available is higher than the historic levels, you ought to be overweight equity, and otherwise you have to be underweight equity.
Yeah, and just to corroborate the point that you were making, we were just drawing up a list of some of the Nifty heavyweights which have not
Yes.
given any return in the last few months. Topping the charts, of course, is HDFC Bank, which has done nothing in the last 33 months. Reliance done nothing for the last 20 months. Even ICICI Bank, which is the most consensus buy on the street, perhaps, for the last 12 months, it's done nothing. And similar is the case with an L&T for the last 2 months, TCS for the last 21 months, Unilever for the last 29, Kotak, Infosys, all added in that list. Specifically on the private banking names and select few though, Maneesh, what do you think is the reason of this underperformance, if you will?
Okay, one of course, as you linked it to macro, that when in general the setup is not great, large part of market doesn't deliver, so someone ought to not deliver, and which turned out to be in this case, despite huge tailwinds as far as banking is concerned, these big heavyweights just didn't deliver, and you cannot fault their micro performance. I haven't seen Indian banking do so well for 15, 16 years. You have to sort of go back to and sort of revisit the 2004, 5, 6, 7 to see banks do so well, such thick margins, very low slippage rates, absolutely great credit growth, and yet they don't do well. And the reason is, of course, what we talked in the first part of our conversation, and it is getting reflected in the largest sector of the industry. But the micro wise, why markets are now, or investors are, despite knowing it fully well that these are great stocks to own, why they're not getting bid up. The reason is that everyone recognizes that the policy construct is now not so favorable. After good 4-5 years, the policy construct for the banking is not so favorable. RBI wants credit to slow down, especially the high margin products like personal loans. And whatever they've done in last 1 month, people who have been in the market recognize this, that until credit slows significantly, these policy measures would continue to come. Liquidity is tight, and therefore the NIMs have no further room to sort of even stay here. Actually, they'll continue to go down. And credit growth and the credit slippages, most importantly, the peak is behind. There are some signs that the slippages are starting to build up. Very little though. So from all angles, the banking sector or the financing sector is sort of facing a little bit of headwind relative to what market expects. I think the future would turn out to be sort of as much now, because market, they have not done well, but these are the sort of three major reasons why financing has not done so well in last 1.5 years despite great macro.
Appreciate your time, Maneesh. Good having you on board to just put things into perspective as to what's in store for the markets, the big risks, as well as overall outlook. All right, and as we take a very quick break, ET now